Will investing in the Max Life online savings plan help you create wealth in the long run or not? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. And before analyzing this policy, let us first understand a few basic details about it. So this is an unit-linked, non-participating individual life insurance plan that offers life protection for your family and provides market-linked returns. And there are two variants in this plan. So some of the key features of the policy are you get to choose the policy term and the premium payment term, and you can also choose from 11 funds as per your risk appetite. And as an alternative, you can safeguard your investments from market volatility by choosing the dynamic fund allocation investing strategy. And there is no limit on the number of switches between funds done in a policy here, and there is also no premium allocation and policy administration charge under this policy. There will be only mortality and fund management charges. And it has other benefits like death benefit, maturity benefit, and also premium redirection, partial withdrawal, which all differs based on the variant option you have opted for. So if you want to know more about it in detail, you can refer to the policy brochure. Now let's take a look at the fund options available in this policy. So fund options are high growth fund, Nifty small cap quality index fund, mid cap momentum index fund, Nifty alpha 50 fund, Nifty 500 momentum 50 fund, diversified equity fund, growth super fund, growth fund, sustainable equity fund, pure growth fund, balance fund, dynamic bond fund, secure fund, and money market 2 fund. And all these fund options here are categorized based on the percentage of allocation each fund option has to certain asset classes like government securities, corporate bond, money market, and equities. And also according to the risk profile each fund option has, which can range from low to very high. Now let us take a look at the advantages and disadvantages of investing in this policy. So the advantages are you have a choice of 14 funds and 2 investment strategies, and apart from the lump sum death benefit, there is the funding of premium and monthly income benefits under variant 2 option, and there are unlimited free switches, 6 premium redirections, and 2 partial withdrawals allowed in a policy year after the lock-in period, and you can also exercise settlement option during maturity. So these are some of the advantages. The disadvantages are there is no liquidity in the first 5 years of the policy, there are no loyalty additions, and even after deducting all the charges, only then the net premium will be invested. The loan option is not available in this policy, and during the settlement period, the investor should bear the investment risk, and the top-up premium option is not available under the plan. So these are some of the drawbacks that we need to keep in our mind before deciding to invest in this policy. As an investor, we need to fully understand the product and estimate the potential return before investing in any product. That's why now, as we have a basic understanding of this policy, let us move on to the analysis part of the video, where to estimate the potential return, we are going to analyze the benefit illustration given in the policy brochure. So here we are going to analyze the IRR, internal rate of return of this policy. For calculation purpose, let us assume that a 35-year-old male opts for this policy for an annualized premium of 50,000 rupees. So he pays a premium of 10 years and gets a fund value at the end of 20 years. He has chosen a balance fund. So the life cover is 10 times the annualized cover, that is 5 lakh rupees. So here the assumed rate of return are going to be at 4% and 8% per annum respectively, indicating worst and best case scenario for a balance fund. These rates are just gross rate of return, that is before expenses. They are not guaranteed returns, and neither are they the maximum or minimum returns that may be achieved from the funds you have chosen in this policy, because several factors like future investment performance will actually affect the returns of this policy. So this is just an example scenario. So in the 4% rate of return, the fund value at the end of 20 years is 7.38 lakhs and the IRR is 2.53%. And under the assumed rate of 8%, the fund value at the end of 20 years is 13.21 lakhs and the IRR is 6.36%. So here here this policy is a market linked return product, but the IRR that we calculated in these example scenarios is far lower than a debt instrument return. So a long term investment fetching lower returns will actually affect our financial goals, and also the sum assured given in this policy is too low. So as this policy has not given us the desirable outcome that we need, let's move on to the comparative analysis, where we are going to explore an alternative strategy where instead of investing in a coupled up insurance where we invest in both insurance and investment in one plan, we are going to separately invest in insurance and investment in this alternative strategy and use the metrics for a fair comparison and also to do a comparative analysis. So here, in order to get life cover, we have opted for a pure term policy which will give us high coverage at a lower premium. So a pure term insurance for 5 lakh cover would cost an annual premium of just 4,500 compared to the max life premium which was 50,000 rupees. So the premium paying term is 10 years and the policy term is 20 years. So after paying the annual premium, the balance amount of 45,500 could be invested as per your choice and risk appetite. So here in this scenario, we have shown both debt instrument and equity instrument returns as an example for you. So in the term insurance plus PPF combination, which is a debt instrument example, PPF has a lock-in period of 15 years and then it could be extended for a period of 5 years batch. But in the earlier example, in the max policy, the premium paying term was 10 years. So in this policy, because of that, in the PPF example, in the year 11 to 15, a minimum contribution of 500 rupees per year is made, because you can see we have made some adjustments to make this example work. The final maturity will be available at the end of 20 years. And in the term insurance plus ELSS combination, which is an example for an equity instrument, the first 10 years after paying the pure term insurance premium, the balance just goes into the ELSS fund. For the next 10 years, the fund will grow as such without any investments, and at the end of 20 years, the fund value is subject to tax and the tax calculation is presented on a tabular column for your reference, which you can pause and see. So the IRR for term insurance plus PPF combination is calculated at 6.47%, and in the term insurance plus ELSS combination, the IRR is calculated 10.65%. So the final maturity value for PPF is 13.42 lakhs, while this might be a little bit similar to the benefit illustration of 8% scenario in the max policy. What we need to keep in mind is that PPF is a debt instrument and it is giving us guaranteed returns, while Max Life Online Savings Plan is a market linked product giving us similar return to a debt instrument like PPF. So under mutual fund ELSS combination, you can see that pre-tax maturity value is 27.77 lakhs, and even after the deductions of capital gains tax, the final maturity value is 25.02 lakhs. So here the IRR 10.65% is which is calculated on the post-tax return is also a rate far above than an inflation rate. So any long-term investment beating return should beat inflation comfortably, can help in meeting our goals. So what is the final verdict? Is investing in the Max Life Online Savings Plan worth or not? Under this policy, a portion of the premium paid is allocated towards life cover and balanced towards savings or investment. So this investment component helps policyholders build a corpus over time which can be utilized to meet various financial goals. So the plan offers different investment fund options such as equity funds, debt funds and balance funds, and policyholders can choose funds based on their risk appetite and financial objectives. But it is crucial to review the plan's terms and conditions, investment options, charges and benefits in detail before making a decision like this. So the plan does levy various charges. This pulls down the return in the long run, and also the plan doesn't offer adequate life cover. So in case of eventualities, the sum assured will not suffice the family's basic needs. And a pure term policy is the most appropriate life insurance plan where you get high coverage even at an affordable premium. So it is advisable to buy a term plan for your insurance basket, and a tailor-made investment portfolio which can be done even with the help of a professional will be the best choice for your investment basket.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, We also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.